Once again, thanks for tuning in. Holly Shields here for Kalkine Media. What is a risk-free investment? Before we get into it, please sub to our channel, and while you're at it, press that bell icon to stay ahead of the game. A risk-free investment refers to the investment in an asset in which the return exists, but there is no possibility of any kind of loss or risk. No risk exists in the risk-free asset. The return is generally equal to the current market rate of interest. In the case of the US Treasury or any debt which is issued by the government bodies, the amount of risk is very small. Therefore, they are considered a risk-free asset. So, what's the working of a risk-free asset? Well, when an investor makes an investment in any asset class, a rate of return is expected by the investor based on the duration for which the asset is held. The risk is the difference between the returns earned and the returns which are expected by the investor while making the investment. Market fluctuations are hard to predict, due to which future return cannot be estimated in advance, and the unknown future creates the possibility of risk. A higher level of risk means higher fluctuations or deviations from the expected return. However, the risk can translate into both losses and gains. Risk-free investments can generate returns as per the expectations of the investor. Since the rate of return can be predicted, it indicates that the amount of risk is very low. Thus, the expected and actual returns are generally the same. The return is known in the case of the risk-free asset. However, it does not mean that the profit is guaranteed in terms of the purchasing power. The purchasing power associated with the risk-free asset can decline over time due to external factors like inflation. So, what's the relationship between returns and risk-free assets? Well, risk-free return is a theory that stands for the investment opportunity, which will provide guaranteed returns with no risk existing in the investment. The risk-free rate is the interest rate that is expected while making an investment in the risk-free asset for a particular duration. The returns from other financial assets are measured against the risk-free rate of return. When an investor invests in an asset that has a higher risk associated with it, in comparison to the treasury bills, naturally the demand for the return will be higher. The difference between the risk-free return and the return earned is termed as the risk premium. What is the reinvestment risk? Well, the risk-free assets are not seen as risky in the sense that they are not likely to default. However, risk-free assets are not immune to reinvestment risk. If an investment remains risk-free from a long-term perspective, then it's necessary that there is a reinvestment opportunity that is also risk-free. Moreover, the rate of return might not remain constant from the date of investment till maturity in the case of long-term investment capacity. What is the risk-free rate? Well, a risk-free rate is the rate of interest that is expected by an investor while making an investment in a zero-risk financial asset. In the financial markets, the rate of return on a 3-month treasury bill issued by the government is considered as the risk-free rate. Commonly, it's seen as the safest investment which can be issued by any investor. Risk-free rates only exist in theory and not in the pragmatic environment, as all types of financial assets have some amount of risk. The risk-free rate is different from country to country. For example, if an investor is making an investment in the US market, then for calculating risk premium, the rate of return on the US T-bills should be considered. Similarly, an investor making an investment in the Australian market can invest in treasury notes issued by the Australian government and should keep a tab on the rate of return on them. Risk-free rate also impacts the stock market. When the risk-free return increases, then the businesses are under pressure as they must meet the expectations of the investors by delivering higher returns. the profitability projection and keeping the stock prices up becomes the priority. However, from the investor's perspective, the increase in the risk-free rate is a positive sign because it means that investors can demand a higher rate on other investments. Now that you're up to speed, check out some of our other videos to boost your financial IQ. If you like this info, please head to our website at kalkinemedia.com. Don't forget to give us a like, comment, and a share as well. This has been Holly Shields for Kalkine Media.